So, this is obviously an attractive market. Product development has got, you were mentioning R&D. Can you talk a little bit about the product development, building an investment vehicle? The DC market is very different than the DB market. I mean, you mentioned that now we're talking about individual participants with all different levels of education and knowledge about investments. It's building a product that can satisfy the marketplace, but also is easily or semi-easily understood by individual participants. And so when you're thinking about it with your team back at Pantheon, you're trying to develop a product. Are you trying to develop a product for the individual participant that would be part of the core lineup? Or is it more towards what we were talking earlier with some other folks around the custom target date or the target date sleeve in the plan? Because that's where the assets are growing in the program.
It's actually both. So this all started about 2.5 years ago with the creation of a white paper, which involved, basically me going around and interviewing a lot of DC plan sponsors, which is where I met Michael Riak, who has joined me now from Verizon, as well as many law firms that had a lot of expertise in the business. Because initially, when I looked around and didn't see any private equity in DC plans, I thought, geez, there must be a law or regulation. There must be some reason for this that no one's given it, really tried it out. And what we determined is there wasn't. There is no deal breaker. But if you think about a DB plan, it's a fungible pot of money that is managed by the corporation or the state, and you don't have to attribute it back to an individual account. So things like the J curve, paying fees in anticipation of returns, are big issues. Not having daily pricing, because DB plans didn't care about that. Not having embedded liquidity in the product is an issue, because in DB plans it's rare that they sell. And so we then engaged, once we identified those things, in a 1 to 2 year process of building modules that would handle that. We decided to focus on target date funds because they need the least liquidity. Everybody in our product can switch daily, but historically people in target date funds don't. It's the default option. They tend to be people who don't know that much about investing. We created an algorithm, a model that we can price these portfolios at on a daily basis with an extreme accuracy, and we actually filed a patent on that. It's pending, but we think it's special enough to have done that. We've created an evergreen account in both a CIT format and a 40 Act format, where we can mitigate this J curve I talked about. So if I'm an employee today and we sign a contract for a new fund investment and it starts paying fees, I'm not paying fees with you becoming a new employee 3 years from now and coming in and diluting me on the investments that have been made. So I paid more fees than you paid. We can equalize that by having an evergreen account rather than the traditional, you raise a fund now, pay fees, invest it, liquidate it, and then do another one. And so it took some time. We also had to create an array of service providers, a trust company that get them comfortable with this, an auditing firm, get them comfortable with our daily valuation model, because they've got to audit the valuations, and an administrator and custodian. But we've been able to accomplish all that, and there are some other competitors that have done similar things, and so I think it's coming to the boiling point, to be honest with you. There was an announcement last week about one of our competitors onboarding someone. We are on track by the end of the year to do something similar, and with reasonable scale. And I think what will fall out of that over the next year or so is some real DC plan adoption, because the folks that have set up custom target date funds, they basically are already have stated to the world, we're willing to go and do the extra work and to take some incremental risk to hire individual managers and to create our own asset allocation. And that's basically what the DB plan industry have done for 50 years or more. So they're importing that technology from DB. And private equity is the single most successful alpha generator in DB over the last 30 years.
So difference between DB and DC plans is around the education. It's all participant directed. And so clearly there's going to have, education is a very important component to plan success. So if you include a private equity or even any alternative investment, either in the core or in a target date fund, it's going to take additional communications to ensure that plan participants understand what that investment is and how
well,
it
I'm glad you
works.
asked that because you're right. You've got to tell people what you're doing, but the level of education and disclosure is vastly different if you include the private equity as a sleeve in a target date fund or if you put it in as a standalone option. As a sleeve in a target date fund, we've already created the disclosure because we've had people ask us, what am I going to have to do? How much brain damage? It's about 2 paragraphs. And you don't really have to educate because this is the professionally managed component where the beneficiary is depending on the plan sponsor and their consultants to basically do the right thing for them. So you identify it, but you don't have to get them too involved in the decision making. And it's also a fairly modest sleeve. It's a standalone option. You're talking about several pages of disclosure, a lot of it ugly, the risk disclosure, because that's the way these things go. And you would have to educate people. And we honestly don't believe, with the exception of certain categories of employees, maybe employees at an investment bank or at a consulting firm, fairly sophisticated employees, that's actually that doable. It's interesting to juxtapose it with the private wealth business where you're seeing the development and proliferation and delivery of similar products. There at least you've got regulations that define what an accredited investor is, $1 million net worth, $200,000 annual income, or a qualified purchaser, $5 million net worth. So that kind of screens those folks out. In a DC plan, because even as a standalone option, the DC plan is the investor. You could let people in that just aren't making enough money that they really shouldn't put their capital in a private equity or a hedge fund investment. And the risk is that they'll do too much. They'll read an article and they'll get excited about it and they'll bet the ranch,
Yep.
so to speak.
And we've seen that with other asset classes, tips as an example, where they just, it's just hot and all the money goes there and then ultimately.
And people tend to get whipsawed, so they'll buy it when it's hot after it's had a good run and then they'll go out. So we think professionally managed, dealing with a plan sponsor, we're most comfortable with that anyway. That's what we've done for 33 years, except on the DB side.